We're coming in.
Awesome. You guys love that windstorm 2 days ago?
Oh yeah,
Yeah.
Our grill took a beating.
Did it?
I just heard a big noise outside. And I ran out there. And it was our grill. Luckily, nothing like bad happened, but it just came crashing down on our
Yeah.
side.
It's just air metal gear.
Yeah.
You
Yeah,
Jim lost a trailer.
Yeah.
know.
Yeah, wild. We didn't have any damage, luckily, but yeah, that kind of sent some patio furniture flying for
Oh
sure.
yeah. I was
Yeah.
kind of scared for a second.
You love that when it happens in April,
I know.
when we're all getting ready to go swimming
Yeah.
at the lake, and another fun road snowstorm
Yeah.
files through.
Yeah.
So, well, cool. Well, we're just kind of hanging out for just a second while we let all of our guests populate into our meeting. We have a full house today, so we'll just give it another second or two while everybody's jumping in, and we'll get started. So it's going to be a good call today. We'll keep it to 30 minutes and hopefully give you guys just a fantastic amount of information and stuff to think about while we're in this short AWA Market Minute. So we'll go ahead and get started. So welcome, everyone. Welcome to today's AWA Market Minute. We do these on a monthly basis with our investment committee to benefit you, our clients, as we break down today's headlines, current political events, all the potential news that may be impactful to your retirement. And we try to do it in a way that arms you guys with the best information, digested information, so that you guys can then take that and figure out the best way to navigate through today's current political and economic climate. So with that, I'll introduce the investment committee again. So Mason Page, investment advisor here at the firm. Scott Hoxer, he's our chief investment officer here at the firm. And then Jaron Monk is also an investment advisor here at the firm. And I'm Paul Coles. We're excited to welcome everyone on the call today. We're going to be talking about smart retirement and dynamic distribution modeling and how that applies to you. Before we get into these concepts, I want to make sure that everyone understands that these are intended to be generic in nature. They're not designed to be acted upon specifically without having first reached out to us on a one-on-one consultation. It's intended for a broad audience. It's not supposed to be considered tax, legal, or investment advice on this kind of a format. It's just educational and really entertainment. So give us a call. We can talk about your specific situation after we're done. So with all that housekeeping, let's dive in. Today, we've got on our investment committee better than 60 years of professional education and experience when it comes to the financial world and the financial acumen that we hold. I think sometimes that translates into a disconnect between financial concepts and then just kind of the average retiree, right? In other words, I think sometimes that we talk about terms and concepts that are just very second nature to us, that to the average retiree, maybe they don't have the benefit of some of those longer term educational opportunities to understand these things. So I wanted to go rapid fire succession for a minute to just talk about some of these basic concepts. So let's go ahead and begin, shall we? Mm-hmm. Jaron, would you mind teaching us what is dollar cost averaging?
Yeah, so with dollar cost averaging, a lot of people get nervous about the volatility of the market going up and down. So a lot of people in their 401ks, or if you get dividends, you have a slow drip of money going into any given investment account. So if the market, say, going down over a couple of quarters in the year, you're slowly putting money in at different increments, so you're really getting a discount on each price point in the market. And the idea is, as that market is ebbing and flowing over time, you're really trying to get an average per dollar with all money going into the market. So it really decreases the volatility of putting lots of money in all at once.
Awesome. So if I'm not paying attention to market movements, but every 2 weeks in my 401k, I just throw my annual percentage of my paycheck back into it, I'm getting a benefit when the market's actually dropping because I'm buying those shares at a loss, which means at a discount, which means when they appreciate in value, they're appreciating at a much more significant pace than the ones I bought before. So that's awesome. Okay. with that, then Scott, talk to us about this concept of traditional asset allocation and maybe the 60-40 rule.
Yeah, sure, Paul. So traditional asset allocation is the notion that you can spread your assets across different categories, and in doing so, still have a solid return, but significantly reduce risk. And this is founded in something called modern portfolio theory. It was developed in the 1950s, not so modern anymore.
Right.
But the idea is that one can spread out one's assets across different categories, reduce risk, and still earn an adequate return. The 60-40 rule is kind of a corollary to that, where it postulates that you can put 60% of your investments in stocks, 40% in bonds, and capture a lot of the market upside while providing some downside protection.
Okay. All right. So modern portfolio theory, 1952, published. And how applicable is it today? Well, we've got interest rates lower than they've ever been in the history of ever. We've got, volatility higher than it's ever been. We've got longevity, people's life expectancies living longer than they've ever lived in the history of ever. So some of these principles that were developed 70 years ago are tough to apply today. But the principle basically is we can take this amount of money and allocate it across different industries and sectors of the market, and keep within a certain parameter of 60-40 between equities and fixed income, or whatever the number is. And in theory, that's the best way to invest our money. Mason, talk to us about how the application of that principle applies in retirement with this quote unquote safe withdrawal rule.
The safe withdrawal rule is where economists have tried to figure out how much money you can actually take out of your savings and not run out of money. So economists have done lots of different studies, looked at lots of different options and ran a lot of different scenarios to see what this is. And so when you've got a retirement plan or money that you've saved up for a long period of time, how much can you take out per year without running out of money? And the safe withdrawal rule has changed over time. But if we're looking at the modern portfolio theory, it started about 5% that you could take out every year without running out of money, went down to 4%. Now some economists say it's 2 to 3% of your portfolio.
Yeah.
So it's something that's constantly changing, but they're trying to find what is quote unquote the most optimal and safe way to withdraw money in retirement.
Right. So if I follow the traditional asset allocation model, then I can take a percentage of that portfolio out pro rata every year, and in theory, not run out of money based on whatever that percentage was. And so they develop these Monte Carlo simulations to run millions of different possible outcomes with all the different variables plugged into this supercomputer that calculates these. And then they kind of assign a probability, right? A failure probability. And so they say, okay, this was all developed by an economist named Alfred Benjamin. And he said, if we can take 5% of our money out pro rata on this traditional asset allocation model, we likely will not run out of money. But then they added more data as time went on and watched, actually had observations of people failing in this principle in retirement. So they cut the number down to 4% to say it's safer this way. And then they came out in 2013 and actually said Wall Street Journal had an article, the 4% rule is dead. Said, it doesn't work as well as we thought. In fact, T. Rowe Price ran a study back in 2000 that ran into 2013, and they had found that if you had followed the traditional asset allocating portfolio model with a safe withdrawal rule of 4% and a 60-40 blend of stocks and bonds, and you'd gone from 2001 to 2013, you'd lived through that financial crisis of 2008 and 9, you had less than a 30% chance that you would not outlive your money on that trajectory. I mean, imagine getting on an American Airlines flight today, and the pilot gets on the comm and says, welcome aboard to your flight to sunny Southern California, local temperatures, 82 degrees. With our headwinds and fuel capacity, we have less than a 30% chance that we are going to arrive safely at your destination. Thank you for flying American. Right?
Yeah. So you say, where's my car?
Yeah, I can drive. I can drive. It's a little safer. But so you get the idea, right? This is obviously a principle that's not very well applied to today's retirees. So Scott, teach us about this idea of dollar cost ravaging.
Yeah, so this is pretty much the inverse of what Jaron described. So when one is acquiring wealth or saving for retirement, you're incrementally adding at different market levels. And when markets are down, that's actually beneficial because you're buying investments cheap. When you're taking money out of retirement, If you take out during those down periods of time, you ravage your portfolio. And the reason being is you sell at a loss and you kind of cannibalize your portfolio and you harm the ability of your portfolio to recover in subsequent improved markets.
Perfect. Okay. So enter this notion of what we call smart retirement. So I'm going to share a slide deck with you guys here, and we'll try to walk you through why this matters to everyone here on the call today. All right. So let's go through this. Dollar cost averaging, we talked about with Jaron, you're adding money into your portfolio regardless of where the markets are at. And what this does over time is it actually benefits the portfolio because you're buying at a discount. Dollar cost averaging, what Scott just taught us, as we take money out, let's say we have a $100,000 balance in our portfolio, we have a market loss of 50%, and that puts our value of our shares down to $50,000. That's just a paper loss until we do what? Until we sell out. Okay, now we're in retirement. You guys are in retirement. We don't get the luxury of not spending some of that money. So you have a trip to Hawaii planned. We take out $10,000 for that Hawaiian vacation. That's just a cash withdrawal from your $50,000 of value. Your new position is now worth $40,000. When the market recoups its losses and goes back up to 50% that you lost, your portfolio value will be worth $60,000. That's not 90, that's not 80, it's 60, because you only got back 50% of what you had left at the bottom. Okay, now this is a really fast way, to Scott's point, to annihilate your portfolio. Okay, so we can't afford to make that mistake in retirement, or else we really run the risk of wiping out our standard of living. So I'm gonna blow through this study real quick, but the idea is we got to be very cautious about how much we take and when. All right, so what we teach, this is the safe withdrawal rule that Wall Street Journal published that we talked about. And what we teach in Alliance Wealth and to all of our clients is that these sustainable withdrawal rates are very low today. I mean, Dr. Wade Pfau, he reports only a 1.93% sustainable withdrawal rate if you want to have greater than a 95% probability of making it.
So don't withdraw your money.
So don't withdraw your money. Yeah, it's pretty simple, Mason. If you just never want to run out, just don't spend your 401k. I mean, imagine coming with $1 million 401k, following this withdrawal rule and saying, I can take out $19,300 a year without worrying about running out of money. That seems outrageous, right? So we teach a principle we call smart retirement. Now, JP Morgan and many others had developed these ideas of dynamic distribution modeling, and we simply took those same concepts that are out there today, and we've kind of fashioned what we call smart retirement from these principles. And that is that if we can actually separate our assets amongst different categories, macro classifications of investing, that we can be intentional about where we draw money from in real time based on real market data. So we don't have to just pro rata take money out of our portfolio. We actually have the ability to go in surgically, systematically, and say, markets are good, I'll go from this category. Markets are bad, I'll go from that category. And we can actually do that. JP Morgan found that they could actually have a reduced rate of return on performance and an extended life expectancy in that portfolio by well over 10%. Okay, pretty phenomenal, this white paper study they did. So we call it smart retirement, systematic macro allocation, rebalanced timing. And everyone on the call with us today that's a client, we use this in your investment portfolio. So we break you down into these different buckets. We call them saved, protected, defensive, and growth. And you're all familiar, so I won't belabor the point as to what each of these buckets, individually means. But the one I want to hone in on today is this defensive bucket, right? This notion that we are going to be invested, but the specific format of how we're going to be invested is around tactical managers that are monitoring the market and the kind of secular trends, the market, the macro trends, micro trends of the market, and they're determining what to buy, when to buy, why to buy it based on the actual real-time data. So they're actually trying to win by avoiding losing. They're trying to protect the downside of your portfolio. That's the whole goal of a defensive bucket in your retirement plan, your smart retirement model. Again, the idea here is regardless of where the markets are at, we have the capacity to make withdrawals from our portfolio, even during periods where the markets are really choppy. So we get this call periodically where people will say, well, I think the market is going to perhaps go down over the next 12 months. How do I react to that? And what do we tell them?
Go on that vacation.
Yeah.
Go have fun. Someone is minding the store.
That's right. That's
Yeah.
exactly right.
Yeah.
We've already built the model in case the market does go down over the next 12 months. Your model is built for that, right? And the market could likewise go up. So we've got a real special guest today that we're going to talk specifically to about this concept of smart retirement, and then specifically about this yellow bucket, what we'll call this defensive bucket. And to introduce him, I'm going to actually play a video that kind of sets up the topic. And then I'm going to have Scott introduce our very special guest here. So give me 1 second to get that video teed up.
Fixed income plays a critical role in an investor's asset allocation. It is there to provide income and stability. As investors age, fixed income tends to become an increasingly important part of the asset allocation as they seek income and less overall portfolio volatility. For several decades now, interest rates have generally declined. Because bond prices have an inverse relationship with interest rates, this decline in rates has served as a tailwind for the bond market. However, in recent years, interest rates have fallen to such low levels that many investors have found it difficult to find appealing yields and have wondered if solutions that may have been sufficient in recent decades will be adequate in the years ahead. In 2013, NASDAQ Dorsey Wright introduced our tactical fixed income portfolio. We wanted to provide a fixed income solution that could serve as a core fixed income holding while also having the ability to be tactical when needed. The result is a strategy which gets exposure to different bond classes through exchange-traded funds, or ETFs. The portfolio is broken up into 6 different sleeves. In each sleeve, we compare 2 different bond classes from a relative strength perspective to determine which of the 2 bond classes will be held in the portfolio. For example, in the first 20% sleeve, we compare long-term U.S. Treasuries to U.S. Treasury inflation-protected securities, or TIPS. For the next 20% of the portfolio, we compare long-term U.S. Treasuries to short-term U.S. Treasuries. The remaining 60% of the portfolio is broken up into 15% sleeves, where we compare investment-grade bonds, high-yield bonds, convertible bonds, and emerging market bonds, each to short-term U.S. Treasuries. What happens in one sleeve has no impact on what happens in another sleeve. In other words, we could be risk-on in one sleeve and risk-off in another. 40% of the portfolio will remain in U.S. Treasuries where there is no credit risk. We believe this constraint helps manage the volatility of the strategy. The benefit of using this relative strength-driven approach to determine the allocation of the portfolio is that it is objective and rules-based. It relies on what is actually happening in the bond market rather than relying on any kind of forecast. We believe that this tactical approach to fixed income is preferable to trying to guess or forecast how to best be allocated for the future. What happens if interest rates stay low or move lower? What happens if interest rates move higher? We believe that our investment process can handle a wide variety of economic environments, and that should provide much greater peace of mind for our investors.
All right. Well, with that backdrop, why don't we go ahead and, Scott, would you introduce our special guest today?
Yeah, thanks, Paul. So we have the pleasure of introducing John Lewis, who you just saw in the video. And John is the senior portfolio manager of the Dorsey Wright tactical fixed income model, which many of you on the call own or have an interest in. And, we're really fortunate to have John. John's been with NASDAQ Dorsey Wright since 2002. And he's one of the foremost experts in something called relative strength investing. So, John, great to have you on the call. Really appreciate you giving us and our clients some time. And I think we wanted to start out with just kind of a Q&A type format. So, we've gone over the strategy, and I'm sure we'll get into that in a little bit more detail. But let's start with, perhaps some kind of macro, 30,000 foot type questions. And the first of which is something our clients are asking about, and one can hardly open a financial publication without reading about it. And that topic is inflation. Inflation is ubiquitous in financial publications. And maybe speak a little bit, John, to what the strategy is doing both in the near term and the long term to address potential inflation concerns.
Yeah, sure. So we have set the strategy up to account for different types of economic regimes. So obviously one of those would be a higher inflation regime, rising rate regimes, things like that. And the portfolio is very flexible in that we can invest in different bond classes that do well at different parts of the cycle. So in an inflationary environment, for example, U.S. Treasury securities often do poorly, and especially the long-dated end of the curve. So we can move into the shorter end of the curve. We can also buy different bond areas that do well in an inflationary environment. And when you have that environment, oftentimes what's doing well are things like equities, right? Or we can go into like inflation-protected securities. And also when we have inflation, the economy tends to be doing well, and that tends to benefit high yield bonds. So we can go there, we can go into convertibles. There's a number of different areas we can go in an inflationary or rising rate environment to help generate decent returns that you won't get from other types of bonds.
No, thanks, John. Good context. And maybe pull back the curtain a little bit. How is that decision making affected? Where whether you're going risk on or risk off, or whether you're pivoting to a certain asset class, what's kind of the methodology behind the scenes for you guys to make that decision?
Yeah, so it's a really, really simple kind of methodology, and it's a trend following methodology at its core. And what we're doing is very simple. So in each bucket or each sleeve, we look at a risk asset and a non-risk asset. That non-risk asset is generally short-term U.S. Treasury securities. That's almost like holding cash. So for example, we would compare high yield bonds versus a short-term Treasury. We just divide the price of one by the other and create a ratio line. So when that line is going up, high yield bonds are doing better. And when that ratio line is going down, high yield bonds are performing worse than a short-term Treasury. And then we just look at a very simple moving average. And when the ratio line is above the moving average, we hold the risk asset. And when it's below, we take risk off the table and we hold that short-term U.S. Treasury security. So it's very, very flexible. It's designed to just follow trends. It's designed to get our emotions and biases out of the equation and just put the portfolio to where the strength is at any one given time.
Yeah, and I think that's really a cool concept. And in the video, you talk about it being rules-based, and you just articulated that, where it takes, perhaps the human component out to some degree. And I don't want to put words in your mouth, but there are some rules and governing principles that are fairly fixed as far as what we understand. And in doing so, you take, the human factor or the human error out of it to some degree.
Yeah, for sure. And, running a portfolio isn't, it's not unlike flying an airplane, right? Where most of the time things are fine. And it's those short periods of time where you really need to be prepared and have a good process in order to keep things going. And unfortunately, those short periods of time are really where performance is made and lost. And those are times where people panic. There's all sorts of emotions going on. A lot of times you really don't understand what's happening in the market. So when you have this kind of rules-based system, that allows you to just very, very calmly and objectively analyze markets and just do what you need to do. So we really use that process not only in this tactical fixed income portfolio, but in all of the other strategies that we run at the firm. We think that getting our emotions and biases out of the equation during those periods of stress, that is a really, really important and often overlooked thing, and one thing that we think will lead to good performance down the road.
That's great. I got a question, Scott. So John, last year in 2020, you guys had a banner performance. And as we watched that happen. It seemed a little bit, perhaps, it was an outliner a little bit from the other years. Two questions. One, what do you feel like triggered that? And then two, can you explain to us kind of what drove that outsized performance?
2020 was certainly a great year for the strategy. And it was really a incredible year, for lack of a better term, just overall in capital markets. So there's really two things that drove the overall performance of the strategy. So number one, our timing turned out to be very, very good with the COVID sell-off and then subsequent recovery. And then also our selection was very good, and that was really in the latter part of the year. So the first part of 2020, the performance was really driven by our ability to rapidly de-risk the portfolio during the big sell-off in February and March, and then to put those assets back on, or put risk back on in the portfolio in April and May, and capture not all, but a lot of that subsequent recovery. Now, the second part of the year was characterized more by our selection, which means we had some very good performance out of our investments. We didn't do a ton of trading at all in the portfolio the second half of the year. In fact, once June 8th hit, around then, we were kind of done trading for the year, and the investments we had just kind of worked for the rest of the year. So convertible bonds was a tremendous performer last year, and really was it really did help carry the performance in the second part of the year. Also, high yield bonds performed very well. And then the flip side of that is your performance is really determined by two things, right? Like I've just been talking about what we owned, but your performance is also determined just as much by what you don't own. And we didn't own long-term treasuries by then. And we were really in short-term treasuries and inflation-protected treasuries on that side of the portfolio. And that was very beneficial as inflation expectations started to rise, and also interest rates started ticking up in the latter part of the year.
Well, and that's my next follow-up question to that is as interest rates, are likely going to follow inflation, what opportunities do you see over the next 2 to 3 years?
Yeah, so I think there's a lot of opportunities for what we do in rising rate environments. Obviously, treasuries are really one of the most sensitive areas to rising rates, and we can dial back the risk there, which is what we're doing now. And we might be leaving it there for quite some time. The flip side is we can go to other areas that do tend to perform well. I mentioned high yield and convertibles. Those are smaller areas of the bond market, quite frankly, but we can do them in pretty significant size in this portfolio. And since we have that risk trigger in there to get out of those positions when we think that there might be some risk out there in the market, it's really easy for us to take these larger size positions and outperform a benchmark by doing that when we can take the risk out at certain times.
Awesome.
And I think both you and Paul, John, have articulated an important point. And going back to the COVID drawdown, if memory serves, we had the COVID drawdown. S&P fell by about 33% in 23 trading days. Your strategy, if memory serves, I think fell by about 8% on the drawdown. And because the drawdown was substantially lower, you didn't have as big a hole to dig out of. And I think you've articulated that, where because the hole wasn't as big that you needed to dig out of, you really were able to, have outsized performance on the upside when things came back. Maybe speak a little bit, John, I think we've had some headwinds in the bond market, to say the least, as we've started 2021. I looked at some data this morning. The 10-year treasury rate was 0.93% at the start of 2021 and hit a recent high of 1.74% on March 19th. As a fixed income manager, what kind of challenges did that kind of rapid rate rise pose for you all?
Yeah, so any type of rising rate environment is challenging in fixed income. It's kind of the opposite of a bull market. So whenever you have this kind of bear market scenario, it just does make things harder. For us, whether things are rising very quickly or slowly almost doesn't matter so much, because we do have this very mechanical system that moves us in and out of the different bond classes. So far this year, it's been really good in 2021 on the Treasury side, because we already were really de-risked in that area. So the big rise in rates in the 10-year, for example, didn't really affect our Treasury holdings at all. We already had risk off, so that was nice to see. And there has been some headwinds, obviously, just across the bond market, but things like high yield and things like converts held up much better in Q1. They were still down a little bit, but much less than an aggregate bond index, and certainly much less than long dated US Treasuries. So we were in the right spots for sure. We were able to outperform in Q1, but we were still down a little bit with the rest of the bond market, but much less than a broad market benchmark.
Right, right. So you mentioned earlier, John, about 50% of the portfolio right now is in short-term US Treasuries, and you indicated it may be in that kind of holding pattern for a bit. I assume the trigger to be more risk on with some of those sleeves will just be ratio driven. Is that right? When the ratios get where you'd like to see them, you'll be pivoting out of the short-term Treasuries?
That's correct. So that short-term Treasury exposure, there's a few sleeves where we have risk off. So our investment grade corporate sleeve, that's much more rate sensitive than some of the other credit pieces that we do. And then emerging market bonds as well. And we've seen emerging markets kind of pull back here a little bit, especially on the equity side in Q1. And I think that's kind of bled over into that bond position as well. So we have risk out of there. But yes, if things turn around and if rates stabilize here and even possibly move down or even sideways, we could see risk come back on in that Treasury piece as well. So it's tough to forecast how long we might have that position in the portfolio. It's very market driven, which is always tough to predict. But once those ratios flip and turn, then yeah, we will put risk back in the portfolio. And quite honestly, we like having risk in the portfolio because it's just a much better environment. We can get more yield out of the portfolio. There's more potential return rather than the opposite where we're just playing defense.
Yeah, that's awesome. Well, Ben, do we have any of our clients that they're all scared, John, to ask you any questions? So just kidding. You've done a really good job. I think we want to respect your time and appreciate you taking a few minutes to jump on with us. So we'll go ahead. Mason or Jerry, any questions?
No.
Okay. Well, John, we appreciate you. We'll let you sign off and then we'll wrap up our call. So thanks so much.
Thanks, John.
All right, great. Thank you all very much. Have a great day.
So as we come to the conclusion of this Market Minute, how we want to wrap this up is just remember that we have your investments broken down into these buckets on purpose: your saved money, your protected money, your defensive money, and your growth money. And there will be times when the market is very volatile, very choppy, and the growth money, that red bucket, that is designed to go up and down during those periods because it's going to not pay attention to the volatility. It's buying your holdings based on the fundamentals of what they're buying. So they're going to be up and down in volatility, but over a long run, they are just a fantastic performer. The yellow bucket, what John is speaking to, is one of the managers that we will plug into that yellow bucket. There's several that we use, but John with Dorsey Wright is one of them that will plug into that defensive bucket. And they're designed to capture the data and say, we don't want to participate in this kind of volatility and sit to the sideline. The application of this is phenomenal. As we talk about how to get money out of your portfolio in retirement, we had a client reach out to us who was very concerned because she needed to take a distribution out of her portfolio, and they had mistimed that distribution with the market, and so they were nervous that they would have to sell positions at a loss in order to get that money to go buy this car. And we were able to say, there is no reason to concern yourself. You have a significant amount of the portfolio that's been moved to cash already, right in the period of this market drop. And she said, well, how is that? And she'd forgotten about her defensive bucket. And some of our managers like John at Dorsey and others had already kind of proactively, preemptively put some of that back into cash, allowing her to go buy this car without selling shares of Microsoft or whatever at a loss. allowing those shares to stay intact so that when the market did recover, which it did, she had a banner year also. So we just love our smart retirement model. It applies great to you, our clients. It gives you the peace of mind in up or down markets to be able to know we're at the helm, your money's being watched. We appreciate you guys. You're wonderful clients. We love who we get to work for, and that's you, our clients. Without any questions on the call, I think we'll go ahead and wrap up this month's AWA Market Minute, and we'll sign off from here. Thanks, everybody.